Good day, everyone. Trust you're doing well today. Today, we are talking about five US ETFs that will continue to pay wealthy Nigerians forever, both home or abroad. Imagine a successful Nigerian businessman named Otumba Adeshino. Back in 2016, Otumba had done well for himself. He owned properties in Lagos, had investments in local businesses, and kept a large amount of cash in banks. Then the global financial crisis happened, which badly affected Nigeria. Then came oil prices crash. Then came periods of naira devaluation, followed by inflation. Then more currency pressure happened. Every few years, it felt like something new was threatening the purchasing power of his wealth. Then one day, during a conversation with a friend who had spent years investing abroad, Otumba Additional was asked a simple question, which was, if all your wealth is tied to one country like Nigeria, what happens if that country faces economic problems? That question changed everything for Otumba. Instead of keeping all his wealth in one market, one economy, Otumba Additional started moving a portion of his money into high quality US investments. Not because he wanted to get rich quickly, because he is already rich, but because he wanted something more important. He wanted stability, dollar denominated income, and long term wealth preservation. Over time, he discovered a powerful truth. He discovered that the people who stay wealthy through investing are not, the smartest investors. They are usually the most patient investors. They buy quality assets, they reinvest income, they ignore market noise, and they allow compounding do the heavy lifting for them. Today, we are looking at five ETFs that can help wealthy Nigerians build a resilient US stock portfolio designed for income, growth, diversification, and long term wealth preservation. But before we begin, there is one important point. This strategy is specifically designed for high net worth Nigerians. Why? Because foreign investors trying to invest in the US equities market face a 30% US withholding tax on dividend. That means if an ETF pays $100 on dividend, only about 70% reaches your account after tax deductions. Secondly, meaningful dividend income often requires significant amount of capital, very huge by Nigeria standards. So if you're investing just a few $100, dividend payments might be relatively small. However, for investors deploying tens of thousands or hundreds of thousands of dollars, these ETFs can become powerful wealth building tools. So let's begin. Number one, IHF, iShares US Healthcare Provider ETF. The first job of a portfolio is survival. Many investors focus only on growth, but experienced investors understand that avoiding catastrophic mistakes is equally important. This is where defensive investment comes into play, right? The ETF chosen for this role is IHF, the iShares US Healthcare Providers ETF. Why healthcare? Think about what happens during a recession. People may stop buying luxury items, they may postpone vacations, they may delay buying a new car, but they still need healthcare. People still visit hospitals, people still require health insurance, people still buy medications, people still need medical treatment. Healthcare demand rarely disappears. That makes the sector naturally defensive. Some of the companies inside IHF include United Health, CVS Health. These companies generate revenue from services people need regardless of economic conditions. Now let's see the historical performance. Now, since launching in 2006, IHF has delivered approximately 8.5% annual returns. The dividend yield is modest at roughly 1%. This is not an income machine. Its primary role is portfolio stability. What are the risks? The ETF is fairly concentrated. More than 70% of assets are held in its largest position. That means investors should expect period of volatility. Now, during difficult market environment, declines of around 28% have occurred. However, healthcare demand has consistently recovered over time. For long-term investor, IHF serves as a strong defensive foundation. Number two, SCHD, Schwab US Dividend Equity ETF. This is where things get interesting because many investors become obsessed with high dividend yield. They see 10%, 12%, or even 50% yield and immediately become excited. But high yield alone can be dangerous. The real goal is growing income, which is income that rises faster than inflation. income that grows every year, income that continues even during difficult economic periods. That's why SCHD stands out. Why SCHD? Current dividend yield is around 3%, but the magic lies in dividend growth. Over the last decade, SCHD dividend growth has averaged roughly 11% annually. Its dividend has nearly tripled. Think about that. Your income keeps increasing without adding more money. Now, SCHD owns high quality companies such as Texas Instruments, Qualcomm, United Health, Coca-Cola, Maersk, Chevron, Procter& and Gamble, Amgen. These companies generate billions in cash flow and have long history of, rewarding shareholders. Now imagine investing $100,000. A 3.2% yield generates approximately $3,200 annually before taxes. If dividends continue growing around historical rates, your income could double every 6 to 7 years. That's the power of dividend growth. Many wealthy investors build entire retirement strategies around this concept. SCHD is arguably one of the best dividend growth ETFs available today. Number three, FNDF, which is Schwab's Fundamental International Equity ETF. Now, many investors make a major mistake. They become overly dependent on the United States. Yes, America has been one of the best performing markets in modern history. But history has also teaches us that no country dominates forever. So to that end, diversification matters. Now, why FNDF? FNDF gives exposure to hundreds of international companies outside the United States. But unlike traditional international index fund, it doesn't simply buy companies based on size. Instead, it focuses on business fundamentals such as sales, cash flow, dividends, book value. This helps emphasize financial strong companies. Now, the major holdings in this ETF are Samsung, Shell, Total Energies, Glencore, Toyota, and hundreds of others. The top 10 holdings account for only around 50% of the portfolio. That's genuine diversification. Now, let's see the historical performance. Dividend yield has generally ranged between 3% and 3.4%. Annual returns have historically been around 9% to 11%. For Nigerians, this ETF provides another layer of protection. If one region struggles, another may perform well. Diversification is not exciting, but it often prevents, painful losses. Number four, SPY, which is SPDR S&P 500 ETF Trust. Now, every great portfolio needs a core holding. This is usually where the majority of the long-term wealth is created. For this role, SPY remains one of the strongest options available. Why SPY? SPY tracks the S&P 500. That means ownership of 500 of America's largest companies, including Apple, Microsoft, Amazon, Nvidia, Berkshire Hathaway. Now, these businesses generate enormous profits and dominate their industries. What's the historical performance? Over the last decade, SPY has delivered annualized returns of approximately 15%. Now, a $10,000 investment 10 years ago would have grown to roughly $42,000 or more. That's without needing to pick individual stocks. Now, SPY has survived the global financial crisis, the COVID crash, inflation shocks, interest rate increases, political uncertainty. Every major downturn eventually became another chapter in a long term upward trend. For many investors, SPY should be the largest position in the portfolio. It is the engine that drives long term wealth creation. Number five, VGT, that's the Vanguard Information Technology ETF. Now we'll move to the aggressive growth portion of the portfolio. This is where investors seek exceptional long-term returns. Now, why VGT? Technology has transformed nearly every aspect of modern life. Artificial intelligence, which is AI, cloud computing, semiconductors, cybersecurity, digital infrastructure, software. In fact, technology remains at the center of future economic growth. Now, let's see the major holdings in this ETF. We have the likes of Nvidia, Apple, Microsoft, Broadcom. These companies are among the most profitable businesses in the world. Now, let's see the historical performance. Over the last decade, VGT has generated annual returns of roughly 24% to 25%. That is really extraordinary. A $10,000 investment 10 years ago will be worth around $85,000 to $90,000 today. Now, since launch, VGT has compounded wealth at an impressive rate. Now, let's look at the risk. Growth comes with volatility. Well, investors did experience nearly 30,000 losses in 2022, more than 40% decline during the 2008 crisis. This ETF is not for people who panic easily, but for investors with a 10, 20, or 30-year horizon. Technology has historically rewarded patience. Now, here is a simple allocation for wealthy Nigerians. One possible allocation could be SPY 30% of your portfolio, SCHD 25% of your portfolio, VGT 20% of your portfolio, FNDF 15% of your portfolio, IHF 5% of your portfolio. When you kind of combine everything like this provides growth, income, international exposure, defensive protection, technology upside. However, the exact percentages can vary depending on risk tolerance. Now, what's the most important lesson? The biggest investment secret is surprisingly simple. Most people fail because they cannot stay invested. When market crash, emotions take over. Fear replaces logic. People sell. Then they miss the recovery. Successful investing usually comes down to four simple principles. Number one, buy quality assets. Number two, reinvest dividends. Number three, avoid panic selling. Number four, give compounding enough time. Compounding is often called the eighth wonder of the world because small gains repeated for decades become life changing wealth. The greatest investors understand one thing: time in the market is usually more important than timing the market. So, in conclusion, for wealthy Nigerians seeking to preserve purchasing power, earn dollar income, and build long term wealth, these five ETFs each serve a different purpose. IHF provides defensive stability, SCHD provides growth dividend income, FNDF provides international diversification, SPY provides core market exposure, VGT provides concentrated growth potential. Together, they can create a balanced framework capable of generating income, protecting capital, and compounding wealth over decades. The goal is not to get rich next year. The goal is to build a portfolio so strong that future generations benefit from decisions you made today. And perhaps the greatest advantage any investor can have is not superior intelligence. It is a discipline to stay invested long enough for compounding to do its job. Now, it's important to note that for Nigerians, interested in accessing the US stock market, these ETFs can typically be purchased through platforms like, Bamboo and other regulated international investment brokers available to Nigerian investors. Remember, investing involves risk, and past performance does not guarantee future returns. Always conduct your own research or speak with a qualified financial advisor before making investment decisions. Now, if you gain value from this video, please like and subscribe so you do not miss my next video. All right. Have a nice day. Bye.